people say the real estate market's overheated. I don't think it is. What I think is there is a huge weight of capital that is sitting on top of the cap rate, causing it to be low, causing the cap rate goes down, prices go up. So there's a weight of money on our shoulders causing these asset prices to be just weighted, right? And so sure, we'll see that go up and down over time. How are we finding deals today, right? We are value add players. We don't buy assets and just watch them appreciate. We buy assets we can do something to make it worth more money.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big. Chad Sutton is one of 5 managing partners of Quattro Capital. He's a leader of acquisitions team and the host of the Real Estate Runway podcast. According to Chad, he is a recovering engineer who spent most of his profession in corporate America in space flight with NASA and aircraft with GE before following his passion as a real estate investor. Chad, welcome to the show.
How's it going? Good to be here. And yes, you described me just right. I'm a recovering engineer, a resident numbers nerd, and that's who I am. So here we are, unapologetically.
Man, I love it. Absolutely love it. 90 seconds or less. Tell me, where did you start? Where are you now? How did you get there?
Started off as your typical working class American kid. Had good parents, not a lot of money. Went to school, I was good at building Legos, was told I should be an engineer. Went and became an engineer. Built a lot of really cool things from rockets to aircraft and everything like that in between. Realized I'm just a highly paid slave at that point. Diversified, got into some consulting related work with GE when the stock price tanked, led to an executive role, realized I really don't want to be in corporate America anymore because I'm working for somebody else, making them a lot of money.
Right.
Right after right before the pandemic, finally pulled the plug, exited, and focused on growing my real estate career. And here I am. So plenty to talk about there.
Man, that's awesome. I love it. What, that sounds like a childhood dream come true, right? You're an engineer, you get to go work on aircraft and on, rockets, and you can tie NASA to it. Like that's like every little kid, especially from, if you're a kid from the 80s, like,
oh yeah,
wow, we just landed on the moon less than 20 years before. So you got burned out and said, that's the end of it, huh?
Well, here's the deal. It was fun. I mean, when you boil it down to the engineering side of things, I created some really cool things. I built things that went boom. I shot rockets, I shot missiles, I built aircraft engines. It was a lot of fun. I got to play in some really cool stuff. But the further you get into it, you realize, wow, the first time it was really cool. And then the second project you do, they give you less money and less time and less headcount. And so now you're working harder. And the third one, it's even more than that because now they know you know what you're doing. So you get less money, less headcount, you work harder. And you realize, wow, you're just a necessary evil to the product development life. If the company could come up with this new thing without hiring a bunch of engineers to do it, they'd do it in a heartbeat, right? We're just a necessary evil. I didn't like the lifestyle anymore because, I was never getting more efficient. I was inheriting more work, right? I get better, they give me more. I get better, they give me more. The life was tough. It was no longer fun. So yeah, you're right. I got burnt out.
Understood. Absolutely understood. How'd you get into real estate?
I'm a third generation investor, unbeknownst to me until I was about 25 years old. My grandparents owned a bunch of single family real estate in the state of Texas, still own a bunch of it today. When the patriarch of the family, grandfather, passed away, I started getting curious, and I realized around that time, this is when I was realizing I don't want to work for money for the rest of my life, trading time for money. Started to read that little purple book called Rich Dad, Poor Dad, and every book like it on the shelf. I've got a big bookshelf over here that you can't see that has all those on there. And I realized I need to find a way to diversify time or divorce time from money, to where I'm making money even when I'm not working, and, buying things that makes money perpetually, till kingdom come. And so started getting curious on the family real estate business, tried to replicate it, failed because in Nashville, Tennessee, the single family rental pricing did not really make sense with where things would actually rent. So surprise. And started looking at how to scale the existing family portfolio, stumbled upon multifamily real estate after doing a bunch of research on lots of asset classes, got educated, went to every boot camp, every mentorship program, every collegiate course I could get my hands on, eventually built a business, bought a couple of properties ourselves, and took off.
That is awesome. You're currently, you are part of Quattro Capital, which you guys
That's
have,
right.
Some really well-known names in the industry there on your team. How did you guys build that team?
It wound up being a lot of right place, right time type of thing. So I mentioned we went through a lot of training and a lot of courses. The five of us kind of organically came together. We met at multiple different venues and eventually started seeing each other's names a lot. And it finally came time to do this and say, okay, well, before we start working with private equity and becoming fiduciarily responsible for investor equity, let's go buy a few properties, right? And we're talking like not big things, little 35 unit apartment building size, bought one, then we bought four, then we bought six together. And we finally looked down and said, wow, this is a really good team. We have the numerical side, we have the project management side, we have the equity side, we have the operations management. And so we just kind of all fell into our niche. We decided to build a company around it. And that's when Quattro Capital was officially born in about 2019. So we have a saying here in Nashville, Sam, that it takes 10 years to become an overnight success. Nobody sees the 10 years. They just see the overnight success where you wrote a hit and became a one-hit wonder, right?
Right.
Well, that's kind of the story of Quattro. We all have a lot of professional and real estate experience behind the scenes, but we kind of became known in 2019 and have been exploding ever since. So these days, you mentioned we have some big names in the industry. We've all been on multiple stages across the country and really trying to get our knowledge out there. But we control a little over 100 million in assets under management right now. That is growing rapidly. But we're also not the type of group that is really wanting to become an institution, right? We really don't want to run and become like the next Covenant Capital or something like that. We want to have a nice, maybe, $250 million in assets, help our investors, help ourselves, and enjoy life a little bit.
Right. That's interesting. I appreciate your honesty there and saying, hey, look, we're not going for the massive corporation. Why is that?
We're not building another job here, right? I mean, we all set out to do this to help our families build generational wealth, build, I won't even say passive income because we work for this a little bit, right? But you want income that your time is not tied to, right? And we figured out we can do that a lot better when we bring people along with us, being our investor partners and our private equity partners. And so there will come a time where we're saying, enough is enough. Our investors are happy. We're happy. Maybe we'll buy one and sell one every year or something like that. And we'll just kind of maintain the portfolio. But, in the times that we're in today, it really makes sense to get our hands on everything that we can that is of a certain vintage, a certain size, and in a certain area. And, we're going to continue to do that while it makes sense. After that, like I mentioned, we have no intention, no desire to become a, publicly traded company or a company that gets acquired by a large investment firm or something of that sort. We just want our thing. We want it to be, we want our investors to always be able to pick up the phone and call Chad, call Maurice, call Aaron, call Tammy, and have a one-on-one conversation. We don't want that multi-level organization that we all left before,
How did you guys come? I mean, that's a unique life philosophy for one person. How did you really get that across all five of you to say, hey, you know what? We want to build enough to provide for us, to buy our time back, and to enjoy the time that we have right now as opposed to shooting for the moon. How did you guys come to that consensus across five people?
I think we were pretty close to the same mindset on that in the beginning. I will say certain members of our group, being Maurice Philogene, for example, is probably one of the premier experts on lifestyle design in this world today. So if you haven't spoken with him, just look for Maurice Philogene on any podcast, and you'll hear him talk about financial freedom and the 5 freedoms that he lives by. But we start talking with people like him, and we all kind of come together and we figure out this sounds like the way we want to go. And we kind of ebbed and flowed a little bit on where we wanted this company to go. At one point we thought bigger, at one point we thought smaller, and we kind of Goldilocks it and found just right, where we're building the right size to be able to manage within the current scope of the team, and we hire the right people on a contract basis to manage assets. And then we're really able to get what everyone wants out of this. So it didn't happen organically. We kind of were all in the same direction already, but we've further aligned the more we started building this company, and everyone kind of got on board. So that doesn't always happen. Sometimes you decide, 2 of you want to go one way, 3 want to go the other, and that may happen in the future. But right now we are all aligned in what we want out of life, out of business, and out of real estate. So it's good.
One of the things that you and I talked about before kicking this off was finding liquidity in unconventional places. Talk to us about that.
So this is something that I'm happy to talk to anyone about. It's one of my favorite topics. Maybe you're trying to scale your personal investment portfolio. Maybe you're trying to invest in syndicators like me. Maybe you're trying to figure out a way to build supplemental income streams so that maybe you enjoy being an engineer today, but you may not tomorrow. Maybe you don't want to have to work for money, or maybe you want to work because you want to and not because you need the income, right? Well, the first place you look is your checking account, and you realize, well, surprise, I probably don't have $200,000 sitting in my checking account to go start investing and do that over and over again. Well, you got to start playing the shell game and looking around and figuring out where can I find liquidity? And liquidity doesn't always mean cash. It means things you can convert into cash, right? If you look at everything on your balance sheet, and for those who haven't made a balance sheet, just make a list of all your assets, which would be your, Kiyosaki is going to hit me, but your home will be on that side. Any sort of, you guys can laugh at me on that later. Any sort of thing you own that makes you money goes on the asset side. Anything that you own that takes money from your pocket goes on the liability side. So you can decide where you put your home based on what books you read. But your cars, your bills, everything like that. Figure out your cash flow situation and your assets and liabilities. And what you're going to find is, okay, maybe I have a home. Maybe I bought that home. This is my favorite one, by the way. Maybe I bought that home 10 years ago. Maybe I bought it in a good market like Nashville, Tennessee. Maybe that market has risen tremendously in home value, and I've just been chugging away at my mortgage ever since, right? Most people don't know. You can actually go to your local bank. I'm going to throw out a website, replaceyourmortgage.com. A guy named Michael Lush, I learned this technique from. I've been doing it for years. It works very well. He's a recovering mortgage broker, so that's why he's revealing these secrets. What you can do is go put a first position home equity line of credit on your home. That is a first position home equity line of credit. Those are usually behind a mortgage. So I get it. You're like, wait, that's a second mortgage. No. Banks will actually put a first position line of credit and replace your mortgage. The first thing they do is pay off that mortgage. Sure. Well, all of a sudden you can get up to 85% loan to value, give or take, on your home with that line of credit. And this is nothing more than another checking account now, right? You basically have 3% money, right? It's going to be a variable rate, but you don't pay principal and interest. There's no amortization. It only charges you an interest-only payment on what you have out for how many days of that month. So example of how you use this. Let's say all of a sudden you have a home that is worth $500,000. You go put a line of credit on there for $400,000, 80%, right? Let's say you had a $150,000 mortgage already that you've been paying on for 10 years, right? Well, now you have that line of credit at 400. They're going to immediately pay off your 150. You've got 250,000 in liquidity you just created. Right. Guess what you can do with that? Whatever the heck you want to. Don't go buy cars. Don't go buy toys. Take that money out and go put it in a couple of syndications, or go buy a couple of properties you're going to flip, or go buy an Amazon business, whatever asset you're going to go buy that will make you money, right? Borrow that money at 3%, go put it in that asset that's going to make you 20 to 30% or more. And then when you get a capital event back out of that, go put the money back and do it again. So you have this money you can lather, rinse, and repeat. Think like that, folks. You can do that with life insurance policies. That's a whole nother strategy. You can do that with a number of other things. You can even leverage your cryptocurrency portfolio if you have some of that. So think about assets you own and figure out how to turn it into cash using other people's money, i.e. the bank's money, right? And figure out how to put that money to work for you, making many times over the interest rate that you're going to make. Now, disclaimer, make sure you can cover any interest payment you take out. Don't put yourself into negative cash flow situation for this, guys. But, that's the point. Think about where you can find money to further your goals.
Like you said, there's so many different schools of thought on this, right? There's the guy from your neck of the woods that, would say, hey, pay off your home.
Dave Ramsey.
Correct.
Great guy, by the way. Great guy.
For sure. And for the right person, that approach makes sense. There are a lot of people that heeding that advice would do them a lot of good in life.
Sam, let's talk about that. I mean, because you're kind of talking about Dave Ramsey versus a Robert Kiyosaki or something like that, right? Schools of thought. Guys, Dave Ramsey is not wrong. But you have to think about this. Dave Ramsey is talking to people to whom credit has been a drug. Like you give them a credit card, they will max it out. Like
Right.
they are credit-aholics. Those people don't need credit. Like if you can't handle a beer, don't drink beer. If you can't handle a credit card, don't take credit. So for a lot, and what he's really saying is, if he calls me on the show, he'll crucify me for this. But what he says is, don't take on consumer debt. Don't go take on debt to buy a TV. Don't take on debt to buy a car. Yes, not even a car. That's a depreciating asset. If you're going to take on debt, go do it for an appreciating asset, something that will make you money and it will increase in value over time. He has a nice building that he bought for his company. I think I'm going to assume he bought it. Maybe he's leasing it. I don't know. But let's assume he bought this nice office building off I-65 in Nashville. I'm going to bet you a nickel he didn't pay cash for it. But that's an income producing asset, right? It is benefiting his net worth. But his cars, he bought outright in cash. So think about who they're talking to. But yeah, plenty of schools of thought on this, right, Sam?
There sure are, but I certainly appreciate your just the creativity and finding liquidity and that's the point of the conversation, is to find liquidity in unconventional places. And I have this conversation, and I've talked about this on the show before, but with people where it's like, well, especially some older investors or older people, like, well, I want to go ahead and pay my mortgage down. It's like, you have 30 years fixed at 2.75%. Why are you doing that again? Why? Like, put that somewhere else. We'll make more money on that than
that's right. Yeah, and if you can reallocate any of that money, I mean, I was just talking to a woman this morning about it. And this is just one strategy, right? But this whole HELOC strategy,
right?
The woman is about to go and get a credit line for about $400,000 on her home that she's almost got paid off. She's currently paying a 15-year amortizing mortgage on, which has kind of done her good. And she has about 120 left. Well, her current payment's like $900. She could take an interest-only loan at $400 and pay, $300. Right. So she's going to pay less just in interest charges for more money. And oh, by the way, put it to work at 30% a year or something like that. So you got to start to think about it that way. That's how banks think, by the way.
Correct.
Banks are not using their money.
Right.
Go read anything about how banks really work. Basically, you are putting your money into a depositor account, let's say $100,000, right? They're going to pay you 0.01% interest. So what is that? $100 a year, something like that. Well, they're going to turn around and lend that money back to you or your neighbor or someone down the street in your community who wants to buy a car at 5%. Let's say 3%. Fine, 3%. Okay, that's going to cost that person $3,000 annually versus the $100 you're being paid to put your money in the bank. Their profit margin is ridiculous, but they're making money on other people's money. That's how you got to think about it. Make money on the bank's money, not your own.
Yeah, because your deposits are nothing more than debt to the bank.
That's right.
I mean, that on a bank's balance sheet, your deposits are a liability, which is really interesting. I guess whichever way you want to look at that. But yeah, your deposits are debt to the bank. So
anyway, I can go rabbit hole here, but we're going to put that one where it is. And if you want to reach out to me and talk about this in detail, I'd love to talk to people about this.
Absolutely. I love it, Chad. Let's talk about the acquisition environment that we're in. This will be the last thing we have time here to chat about. But I want to talk about that and how you guys are finding ways to uniquely find opportunity.
Yeah, so it's no secret. People say the real estate market's overheated. I don't think it is. What I think is there is a huge weight of capital that is sitting on top of the cap rate, causing it to be low, causing the cap rate goes down, prices go up. So there's a weight of money on our shoulders, causing these asset prices to be just weighted, right? And so, sure, we'll see that go up and down over time. How are we finding deals today, right? We are value add players. We don't buy assets and just watch them appreciate. We buy assets we can do something to make it worth more money, okay? Used to be you go buy yourself a, dumpy property that someone hadn't been running really well for $30,000 a unit, go inject 30 more thousand a unit to put it back together, and all of a sudden you can sell it for 90 or 100,000 a unit. It's great, That doesn't really work right now, because of what you're having to pay for deals like that. We are flocking to quality. We are spending more of our time buying assets that are built newer than 1980, preferably 1990. We want to find a mixture of blue and white collar resident base. They're a little more stable from an employment perspective should some sort of a recession hit at any given time. And we don't want to be the industry leaders and we don't want to be the slumlords, right? So we're focusing on that. We'll call it that B class asset. Properties are rated from A to D. We're going to find something that's a stable 80s B class asset, and we're going to go put a bunch of money into it. And we're going to make it like to the tune of make it almost luxury, almost an A class asset. And so by doing that, what you're able to do is actually you'll yield rent increases close to $350, $400, which you call me crazy, but you're really competing with a whole nother asset class, and you're putting so much money into it. I don't care if the cap rate goes back 200 basis points the other way. You're still going to make money because you've increased the revenue on that building and the quality of it by so much, right? So it's almost a redevelopment play right now. Is how we're doing deals. And we're starting to look at, do we just want to put some money in some older, older new properties, right? And just kind of sit on it and see how that goes. So, that's how we're finding deals today. You stumble upon, the really good deals that are direct to seller or coming out of a lawsuit or an estate or something like that. You just got to be in the game to find those. Those don't come around every day. We've found a few of those. But, we do still buy market rate deals as long as the name of the game is like, who cares what the cap rate is, right? Everyone's worried about cap rate. Buy the deal where it makes sense, right? And if you can justify buying it at too high of a price, but then decompressing the cap rate over time with whatever value you're going to add to it, you're going to do just fine.
Love it. Love it. Chad, thanks for your time today. Thank you for coming on. Certainly enjoyed our conversation. If our listeners want to get in touch with you, what is the best way to do that?
Very simple. Go to chadsutton.info. That's chadsutton.info. You'll find my contact. You'll find a Calendly link. You'll find a website you can look at. Very easy. chadsutton.info, folks.
Chad, thanks so much. Have a great day.
Thanks, Sam. Take care, bud.